Welcome, ladies and gentlemen, to another series of our fund manager insights. And today I'm thrilled to introduce you to our next guest, Sarvesh Gupta, an accomplished equity investor with over 15 years of experience. He's the founder of Maximal Capital PMS. And with this, Sarvesh brings a wealth of knowledge from his extensive background in both listed as well as unlisted equities. His experience has been advising HNIs, CXOs, NRIs, and family offices with his SEBI registration as an investment advisor prior to PMS. And he had worked at Gaja Capital and played a pivotal role, which was one of India's leading private equity firms. So let's try to explore and pick his brain and figure out what are his views on the markets, and let's also spend some time to understand his journey so far. So welcome to the Fund Manager Insights, Sarvesh.
Thank you, Radhakrishnan.
Sarvesh, as usual, can you walk us through your journey in the investment world from Gaja Capital to founding Maximal Capital in terms of what motivated you to transition from PE to managing your own PMS fund? We'll be interested to know.
Yeah, surely. So, for a very long time, even when I was pursuing my MBA at IIM Ahmedabad and before that doing my engineering, I was very much inclined towards value investing. In fact, in my second year of engineering, the first book that I read in on the field of investing was a very simple book called Buffettology by Mary Buffett, who was actually daughter-in-law of Warren Buffett.
Okay.
So that's how the initial, I come from a community also, I belong to Bania community. So we are definitely much more mindful about the price that we pay for anything that we want to transact, even
Right.
otherwise, against the value that we are getting. So for me, I think, every fund manager, every person has a general and natural inclination towards a certain style of investing. uh, for me, that was value investing because it was something that I could relate to right from my childhood. And when I was in private equity, I looked at many opportunities across sectors in both private space as well as the public space. And what I found out that in private equity, as it is being practiced in India, it's more of a high growth sort of an investing journey, wherein you have to identify the right promoters and hopefully uh, let them execute as per the envisaged plan. And now that also means that you are dealing with a promoter who is in India generally a very smart species. They are not going to issue you a primary security or a secondary security in India, um, unless they are getting a very good price for their asset. So
True.
this is very different from a US context wherein these firms are not promoter driven, not family run, and where the person who is taking the decisions on such deal is not so much aligned with the valuation.
True.
In India, the situation is different, and hence most of the private equity deals also happen only when the markets are really good. So now our my core thesis was to invest more in a contrarian way, which means I want deals which are priced very lucratively. So that feature I feel in India specifically is found more present in the public space,
Mm.
because from time to time, there are bear markets and bull markets, and if you are investing in bear markets, of course everything is cheap. But even in bull market, for example, today we are in a bull market, there are sectors which will always be cheap. So you can draw your attention towards those sectors and you can get very good valuations, which in my opinion, significantly reduces your risk if you are a long-term investor. So hence it was something which alluded more to my personality and my investment philosophy. So after having spent almost 5 years at Gaja, where I was the principal, I decided that I would be doing a far better job in a public market setup. So one of my seniors from IMA, Mr. Nikhil Johri, who used to head BNP Paribas Mutual Fund in India earlier, he was in the process of setting up the equity schemes for his PMS. The name of his PMS was Trivantage Capital, and I got the opportunity to be a fund manager there on some of the equity schemes. So that's how I took it up. It was I must also say that private equity in India pays very well. I Because of my interest in this area, I had to take a pay cut of almost 75% to enter this space. But in the long run, it is all worth it. A public market doesn't pay as much in the beginning years, but certainly, I think for someone who is really interested into value investing, I feel that's a much better space to work on.
Excellent, excellent. One other aspect of yours, probably we'll touch upon that. You have been a SEBI registered investment advisor prior to the PMS, right? So, and
Yes.
your clientele had CXOs, HNIs, even family offices that are, kind of a trend in
Yes.
India. So, what has been your experience in terms of the customer insight? We still have, single digits in terms of the number of people who invest in the capital markets per se, right? When you look at the 140 crore plus population. So, are there any insights, and what has been your experience, advising people on investments?
Yeah. So, first of all, on the penetration point, I would just, beg to differ a bit. See, we have 140 crore, but on an average with a 4.5 family members, we have maybe 25, 30 crore families. But unfortunately, I think 90% of the India has a very low disposable income. So, if
Right.
you actually consider the target market, it is maybe 3 crore families, and out of which already we have 13, 14 crore demat accounts on the last count, if I'm not wrong. So
True.
now we are fairly well penetrated, but of course, as we are seeing, the rich are getting richer, the people who are better off are generating a lot of additional income. So they are entering the market. My experience is more limited to the top end of this sort of 3 crore or 4 crore families which are investing into markets. um, at that level, they generally invest via mutual funds. Many of our customers were the first timers when it comes to PMS or hiring a manager like a registered investment advisor for their wealth management. Uh, but in general, the level of sophistication, the level of education, even amongst the UHNIs, is very low in India.
Hmm.
Slowly it is picking up, but even now, the level of understanding of the markets, understanding of the philosophy is very low. And that is where, when we embarked our journey, we decided that we will not go via the distribution model. So as of now, we are 100% of our clients are direct clients.
Hmm.
And we felt that it is also very important for us as a firm to get the right clientele, because especially, we are not momentum traders or people who are, frequently doing in and outs, etc. Our objective is to be long term invested. So it is very important for any fund manager to choose also the right clients, because for example, I'll give you a COVID example, right? I mean, I got two phone calls, during COVID from two of my clients, and no one withdrew the money. So that really helps you as a fund manager to sort of take your decisions, because no one is, sort of second guessing you. They need to have trust in your capabilities, and also they need to have that long term orientation. Plus, they should be alignment with the value investing philosophy or whatever philosophy the fund manager has. So it is very important to choose the right clientele. It is very important to educate them about how you are going about doing the things and set the right expectations.
Excellent point. Excellent point. Coming to your PMS Maximal Capital, right? So we
Yes.
talked about your journey. Now, can you highlight some of the key strategies and sectors, especially that you're focusing on at Maximal Capital?
Yeah. So Maximal, so basically, as I told you, I mean, earlier, this was set up as a investment advisory.
Hmm.
Um, at one, we used to charge both profit share and fixed fee, and we were disallowed from charging profit share. And at that in 2021, as per SEBI regulations, and then we decided to move to a PMS setup, and we didn't change anything. It was more of the same. The only thing was that the license under which that we were operating changed, and the structure got more formalized. reporting, etc., now are much more, on a frequent basis to SEBI, etc. In terms of what we do, since 2017, we have been doing the same thing. We are essentially a contrarian concentrated value investor.
Mm-hmm.
So, contrarian, as in we tend to look into more into stocks and sectors which are currently facing some headwinds,
Mm-hmm.
but we feel that against the headwinds, we are getting a very good valuation. And also, it is very important for us to ascertain whether the problems that the sector or the company is facing is of temporary nature. So,
Mm.
if the problems are structural, then we don't want to participate in. If the problems are more, for example, there are industries, maybe the theater business, the problem may be more of a structural because they are facing a huge competition with OTTs. So, even though the valuation may be cheap, we may not want to participate. Similarly, there are industries where the problem might be because there is very low terminal value, maybe because of, for example, in case of oil and gas, the valuations are very low, but then, no one knows for sure how EV is going to completely take away the business from them. So again, stock might look optically cheap, but we may not want to participate in it. So we are looking into contrarian stuff which is currently available cheap, but because of certain factors which we feel are temporary and they will mean revert, and at that time we will hopefully end up making a lot of money. Second, we are value investors, which mean that whatever value we are paying basis the normalized earning, and normalized is the keyword here. We are not looking at current earning, but we are looking at a normalized level of earnings. What could this company produce in a normal scenario, maybe let's say 2, 3, 4 years out?
Mm.
And if basis that we feel that if we apply a conservative multiple to it, if we feel that the valuation is uh, a discount to its fair value, we sort of look into it further, do our further research to figure out if it makes sense. Third is concentrated. So that this is also very important. I think most of the people in the market are not able to beat the benchmark because they are very thinly present. In fact, mathematically, it has been proven that once you have more than 18 to 20 stocks in the portfolio of equal weightage and a fair representation of the sectors, then you will start to mimic the market more or less.
Correct.
And that's what is happening in both the mutual fund space, and now as the PMS space has also become bigger. So even the same underperformance. So, I think last 1 year has been exceptionally good because because of the small mid cap rally. But prior 1 year back, when this rally was absent, on a 5 year rolling base data, even I think 70-80% of the PMS schemes were not able to beat the respective benchmark.
Correct.
So the problem why it is happening is because the conviction is not there and people are not able to take large bets, or they have raised too much money and then they are not able to get the float. The float is also missing in India in most of the sectors. So hence it is very important for us to be concentrated, because that's the only way you can beat the market. If you don't have high conviction bets, um, ev- as per sector or as per stocks, so then you will face a problem in beating the market. So we try to, our top 10 stocks typically have like 60-70% plus of the portfolio. So we are fairly concentrated that case. So this is the core philosophy with which we work.
Excellent. So, Savish, you mentioned valuation, and we also touched upon we are in a bull market, right?
Yes,
Everyone is waiting for a dip, but then it goes back up. So, in
yes.
terms of valuations, are there any sectors that you're comfortable with at this point, or do you see the bull market continuing, especially in the small and mid cap, which has actually gone bonkers? So, what are your views, and uh, how do you see this sustaining?
Yeah. So I think, the advantage of being an investor in India is that there is a wide range of sectors and kind of opportunities which are present. Uh, there are a lot of sectors which I think have gone into a valuation zone at which they have become uninvestable. So we are ourselves sort of staying away from them. For example, many of the stocks in defense, power, multinational power, for example, or railways, many of them have gone up beyond their fair value given how their historical past has been, and all the good news has been priced in. So there are challenges in investing into certain segments. At the same time, there are sectors which are presently available at maybe 10 or 20-year low price to book multiple, for example, lending. So there are sectors which are making sense, and there are sectors which are not making sense. And it is very important for us to choose the right sectors from a valuation perspective also. So that is what we are doing. I think in lending, in chemicals, in certain places in pharma, certain places in cement, uh, you are still getting opportunities. But broadly, I agree that currently the valuations are high, and one has to be much more circumspect while putting in the fresh money. So what we are doing at our end is that we are trying to find more of the beaten down large caps. Secondly, we are on the lookout of special situations. And thirdly, we are also holding a slightly higher level of cash than usual to be able to take advantage in case the market fall comes. However, having said that, it is very difficult to predict, as to whether it will happen and when it will happen. I think that is a very difficult task. And there is a lot of money, by the way, in India, which is waiting on the sidelines to get invested in the market should a correction happen. And that is also one of the reasons why the correction is not happening. Because
Right.
as soon as there is some dip, it is getting bought because there's just too much money waiting on the sidelines. Because people didn't had a bad experience. So the biggest feature of the last 10, 15 years of market investing in markets have been that we really didn't had any prolonged bear market.
True.
So people don't have the memory of what a bear market looks like and what is the pain. And I think 80% of the investors who have come into the market, they have only seen 2020 onwards when market has only gone up in one way.
Correct.
So I think so challenges can come because of any reason. It can be geopolitical, it can be whatever. But I think India is placed on a good wicket. So if you're a long-term player, I think it should be less of a challenge. But short-term, medium-term challenges can come anytime. So I think one has to be very careful about managing the risk properly in a market like today. And so, like, from a cricket parlance, sometimes, there are pitches where you can only score 200 runs. So you have to save the wicket. And then there are pitches where you can score 400 runs. So you can go for trying to hit six on every ball. So I think currently it is the market where you have to be much more, focused on risk. And that is what we are doing. And at the same time, of course, if your portfolio picks are good, then you will at least beat the market also if it is going up. So that's what we are trying to do. If market is doing well, we want to at least give the market level return. But if the market does badly, we A want to not do as badly at the market, and B we want to have a lot of cash or value, large cap value, where we can rotate the money into fallen down stocks.
Good. You mentioned geopolitical risks, right? Apart from so, and do you feel structurally the Indian economy is strong? One, and what sort of a geopolitical risk do you see affecting India? So far it has been whatever we have seen wars break out, but still the Indian economy, the Indian market is holding strong. So what can impact that? And are you confident about the structural strength of the Indian economy?
Yeah, so I think if you look at the past decade, 2010 to 2020, broadly, there was no real growth in the economy, which was also reflected in, let's say, the real estate prices or level of infrastructure growth. So the only type of sectors and stocks which were doing well were those who were gaining market share from their peers. So, for example, the PSU banking space was dead. So private banks were doing very well because they were gaining at the expense of them, even though the market was not very growing at a fast pace, but they were able to grow fast, and their valuations were also, quite good. Same was happening, a shift from unorganized to organized. So segments like paints, for example, were doing well because of that. So the growth was only present in few pockets, where some drivers of market share gain was present, even though the market overall was not doing well in most of the industries. I think this decade is probably going to be different because we have just come out of a 10-year sort of a cyclical sort of a low, and maybe COVID was a jolt for the entire economy to shake up and start. Sometimes you have to hunker down if you want to actually fly. So I think we are in a good shape as far as Indian economy is present in this decade. I feel that 2020 to 30 should be a very good decade for the economy as such, because we have just come out of a 10 years of bad cycle. So that I think the confidence is pretty high on that particular parameter, and also the governance has improved, and the kind of participation of government into various policy reforms, etc., has been good. So all in all, I think India is placed quite well. At the same time, in terms of geopolitical risk, so whatever is happening in the world right now is pretty much priced in. So I don't fear any of those. But geopolitical risks are basically, there are unknown risks,
Right.
and they are essentially cannot be predicted, and it can come from anywhere. One must also not forget that since I just spoke that we had 10 bad years, so we the probability is very high that we have very good 10 years. But at the same time, if you look at the world geopolitical sort of a climate, we really didn't had any wars in the last multiple decades.
Correct.
So the probabilities can happen, something can happen which is slightly more than a local war like a Russia Ukraine or a Israel Iran type of a conflict, because these wars were there, but they were primarily sort of uh, between smaller countries and between and a localized level. So I think anytime anything can happen, and that is why I think markets are not pricing in such risk, and there can be a decent fall in case any of those risks are materialized. And from a portfolio management perspective, anyways, so we have to be forever ready, especially if the valuations are high in such a scenario. And that is our objective, that today, for example, for the last 6 7 months we have been holding 10% cash.
Hmm.
Now we have maybe lost out on some returns, but we know that in case there is a fall because of any reason, on that 10% we will end up making 20%
Right.
return. So that's how I think one has to you know prepare yourself better, in especially when the valuations are a bit on the higher side.
So you mentioned that you're sitting on 10% cash. That basically means you're waiting for a good opportunity in the sectors that you have already identified. So without trying to guess which sectors those are, at
Yes.
what uh, level of Nifty would you probably be deploying that cash? Let me ask you that way.
Yeah. Yeah. So our approach is more stock specific and not Nifty specific. In
Correct.
fact, Nifty or the large caps are not so much overvalued as much as some of the small and mid caps right now, especially the mid cap zone.
Hmm.
Because small cap is a very large territory, so you can still find small caps which are making sense. But mid cap zone is overvalued, I think, or probably much more than overvalued across the board, because
Hmm.
that's when the institutions start participating, and people have really taken the valuations to another level this time. But so there are, I mean, from a large cap opportunity size, there are decent opportunities present. We feel that we look at from a stock to stock specific case, irrespective of the market. If we feel that we are getting maybe 40 50% discount to the fair value, we do participate even if the market valuations are high at that point of time. So our search is on. In fact, as we speak, we are looking into one or two stocks which might enter our portfolio in the next 1 month. But yeah, I mean, generally, I think like even the small falls which are happening, we are trying to put some cash to use. So May 15th, May 17th time, we did add or reduce our cash levels because there were some stocks which. So that's the beauty of the market. Market, even if the Nifty falls by 5 10%, sometimes there are stocks which have fallen by 40 50%. And this happened in March this year.
Right.
And at that time, you have to take opportunity, you have to take sort of opportune call and timely calls to get invested into those. So that's how, I mean, we are quite agile from our side to be able to exploit those opportunities.
Great. Sarvesh, let me ask you this. What, according to you, you did say some sunrise sectors, like, you said, lending, especially, is something that you're looking at. So within
Yes.
lending, you have different, sub segments. You have starting from microfinance, then, structured, you have private banks. So I'm just trying to pick your approach. So you have identified lending as a structurally strong sector. How do you go about identifying which stock, without naming them, but how do you go about identifying what is your process, if you can explain?
Yeah, so in the beginning, of course, when we were, doing, maybe 6, 7 years back, we used to apply a lot of filters basis the historical performance, track record, reading all the con calls which are available to understand. But now, we have reached a stage where we have already been tracking so many companies across the board, across the sectors, that we have a decent sense of what is happening in which segments of the market, where the valuations gap exist, where the performance is going to come on a higher basis in the coming years compared to what it is now. So I think now it has been because of the collective experience that we have gathered over the last several years. It comes to us intuitively. This is actually, I think there was this book on, 10,000 hours of focused practice, right?
Right, right,
So
right.
since we have done that, I think now as a fund manager, our intuition actually goes on a very, I mean, it is slightly less objective, but then this is one of the, things that I have realized, that over time, as you work hard, maybe if you're thinking about investing 12 hours a day for the last 10 years, things do come to you on a, some things will make sense to you in 5 minutes. And of course, you will do all your analysis, you will get your analyst to work out the models and look into all the reports and all. But many of the things will instantly make sense to you. And many of the things, more importantly, will instantly come out of your shortlist, because you would know that this is not something that we would be interested in. So, so as of now, within lending, what has happened is that once you have seen a fall in HDFC Bank's valuation, that has put a cap on the entire sector's valuation.
True.
Because today the question is that if you like anything in lending, why not just buy HDFC Bank, which is available at 20-year low price to book, and maybe a 10-year low or 15-year low price to earning. So so the opportunity is quite good across the metric, across the, whether be it private banks, be it microfinance, be it NBFCs, the opportunity is quite good. These companies are growing sustainably on a high rate. India cannot grow without the lenders not growing and doing properly. RBI has also recently put in a lot of checks and balances which have hit the valuations negatively.
Hmm.
But in my view, these will actually help the sector positively, because at least the most important reason why the valuation in lending sector can go down is because of the credit cost, more important than anything else.
True.
And I think every step that RBI has pursued is basically towards bringing down the sustainable credit cost in the sector by putting in more and more checks and balances. So as and when these things get digested, I think you can see good valuation re-rating, and the growth is anyways going to happen. For large companies maybe at 15% or thereabouts, and for small companies at 20-25%. So there are many candidates who will grow consistently in this space. And against that, you see the valuations, they are at pretty low compared to their historical past. So there is a possibility of re-rating as well. So we feel this is a sector where one should definitely be putting in some money to work as of now, especially when many other sectors are much more expensive. And the other one more thing, by the way, which I forgot is, FIIs have been selling a lot.
Hmm.
And in India, this is one of the, again, a very India specific thing, that the float is very high in BFSI stocks. The liquidity is very high. A 5,000 crore market cap BFSI company has liquidity as much as maybe a 25,000 crore non-BFSI company. There is no liquidity outside of, especially in good companies, outside of lending. If you see, 75% will be held by promoter, 10% by some good investors, and 5% by some funds. There is hardly 10% float available. So those sectors, the valuations also can show us a distorted picture. And here, I think the float is there, liquidity is there. FIIs have been selling, and most of their selling comes in foreign, in lending sector. For example, in HDFC Bank, earlier there used to be an auction because the foreign limit was completely, taken by the foreigners. Right today, against 75% limit, only 58% is bought by foreigners.
True.
So the burnt of FII exit has also been, from a technical point of view, has come to lending sector in a large way. So in case they come back, because the India story is strong, and once the election related uncertainties also go away, and most importantly, when the rate cycle sort of comes down, this is not probably going to happen in 1 year, but I think for long term investors, it's a good time to accumulate and take advantage of all these three macros also working in their favor, like FIIs coming back, and lending rates going down, and the RBI policy is getting digested by the market.
Cost of capital. Yeah. Recently, the gold NBFC stocks went down because of the 20,000 limit. But as you rightly said, it's structurally strong for the organized players versus the unorganized ones.
Yes, yes, yes. It will benefit the organized players more, and it will make the companies also strong because they will be forced to make these changes. So they, of course, in the short term, it will create some business model challenges, but in the long term, it will make them I mean, as I told you, the credit cost line of their P&L will get strengthened by all these actions. Because, for example, if you're lending everything in not in cash, the possibility of fraud goes down. The possibility of the responsibility on the credit officer goes up. Because I mean, everything sort of starts to make much more sense.
True, true. You mentioned earnings calls briefly. So at AlphaStreet, we pride ourselves in covering maximum number of Indian calls, and my team just alerted me before the interview that you regularly appear in many earnings calls asking questions. So what has been the role of uh, technology per se with new tools for you to better filter companies? How has the investing landscape and market analysis changed? From when you started to now.
Yeah,
Are
yeah.
there any
So,
new tools? Are there any new indicators that you look at?
yeah. No, so there are many tools available in the market, and we do, I think, so one of the challenges as a fund manager is that we track too many things, and then we miss out on many of these calls. And Alpha Street, for example, is a great way for us to catch up on those calls immediately, because you guys are able to upload it, and on YouTube, it is much far better to sort of listen in as per your own pace, because the other challenge is the time. So we are able to sort of fast forward it. We are able to sort of go up and down to sort of listen some parts of the call again, also to get better understanding. So obviously, what all this technology has done, it has democratized the landscape for many people who are investing into the markets. I think earlier there was an information arbitrage, there was an analysis arbitrage, and there's a timing arbitrage. Basically, if you want to create alpha, there are three gaps. There are three things. One is your edge, which you can get from information. One is the edge which you can gain from your analysis, and third is the edge which you can gain from just being philosophically long term or something like that. I think what technology has done earlier, all the institutional guys only used to have, large guys only used to have the information at the right time. Now, with the help of technology, everybody is getting the same sort of information at the same time. So technology has played a great role in democratizing, and this is what SEBI also wants, right? So irrespective of, even if one person is holding one share, or if the person is holding 1 crore share, the access to the information on the company should be the same. And technology, I think, has played the great role in making sure that is done to everyone, and also at a very low cost, in a very big way. So that's very good. And on our side, we do try to take advantage of many of these new age tools to sort of do our analysis more efficiently and in a faster turnaround time. And it has definitely sort of helped us a lot. And we are very much looking into all the possibilities that are present in the market so that we can make our research process more efficient.
Sarvesh, mutual fund is sort of an established no industry from within the confines of investing, whereas PMS is a new entrant, the new kid on the block, right? So
Yes.
let's say mutual fund is a test match versus PMS as a one day cricket. Uh, who is the ideal person for you from a customer perspective who are listening to this, right? Or when should I think of switching from mutual fund to PMS? What is the ideal customer profile for you?
Sure. So on this, having seen so much of data, I think there are two or three very important points related to the question that you asked. A, now the mutual fund managers are very good, right? I mean, all these mutual fund managers are probably more skilled than any of the PMS manager. But however, the law of gravity in the field of investment management is that everything else remaining the same, the expected return is inversely proportional to the assets under management.
Hmm.
The problem with mutual funds in India today is that they are managing too much money, which is also growing to increase so much more. So you cannot beat something which you are a big part of. So mutual fund themselves, are becoming a very large part of the market. They will continue to grow because there is a large population, and they will only trust an HDFC or an ICICI. If I have 5 lakh rupees, 10 lakh rupees to invest in the markets, they would definitely trust them. And that is the way they should also, because, uh, with a limited amount of money, that will be the most cost efficient way. So people who are starting out should definitely go towards mutual funds, but they should also understand that there is a very high probability that the returns that they will generate will not be in excess of market. In fact, 2 days back only, even there was this article on the large cap funds which have beaten the market, beaten the Nifty. It was on Money Control or somewhere, and I saw even the top funds have actually beaten by like 0.5% or 1%.
Hmm.
So it is very difficult because they are also handling retail money. So SEBI also puts in a lot of restrictions, if typically, except for the benchmark stocks where, people are happy to take it up to the benchmark weightage. Other than that, they would hardly take 1 or 2% weightage. Problem with, as I told you earlier, also mathematically, once you have so many stocks, you will start mirroring the market because you have taken one cement stock, one defense stock, one chemical stock, one pharma stock, one HDFC Bank, ICICI Bank, Kotak Mahindra Bank, Reliance. So it is very difficult for the mutual fund manager. Uh, it is just the structural problem for them to beat the market,
True.
and that will persist. Now, hence there are people in the PMS who can probably do a better job. But again, in the PMS also, some of the PMS fund managers who will try to do things in the same way as a mutual fund, they will find it very hard. So one thing is, for example, if you're running a small cap strategy and you're running 1,000 crore, 2,000 crore, it is very difficult because the float is not available. As I said, beyond BFSI, there is no float available. So you are essentially like a private equity investor. If the markets fall, you can't exit with a 100 crore position in a small cap. So, so you have to. So the brilliance of Warren Buffett, for example, was that he was a great small cap fund manager. Then he became a great mid cap fund manager. Then he became a great large cap fund manager, and now he's only a buyout manager. He is only looking for buyouts. He's not even looking for buying from the market because he needs 40-50 billion dollars. So very few fund managers are able to transition from one place to another. That is the problem, even in the PMS. But they get too much money. And once, if they are not able to transition, a small cap fund manager has to transition into a mid cap fund manager. after 5-10 years when he has
Correct.
thousands of crores of money. And from small mid cap, he has to again transition to a large cap fund manager once he gets 8, 9, 10,000 crore. So that journey is very tough, and very few are able to do. So from an investor perspective, they should also understand that whether the past track record is not the only thing. The other important point is that the range of AUM that they are managing, will they be able to succeed in that AUM range? I mean, there was one PM, I won't name it, but there was one PMS, very famous PMS, which was managing 1,000 crore 2 years back, and 1 year back from 1,000 it went to 10,000. And I feel that it is very, very, very difficult for someone to successfully replicate the returns, but people don't understand. Even the HNIs and UHNIs, their level of sophistication when it comes to understanding these issues is very low. So people feel that, okay, at 1,000 crore, he has produced this return, 10,000 crore also someone money will come. That is not going to happen. So one has to be very careful about picking the right fund managers, and also understanding the principle of gravity, which I just told, that size of AUM is inversely proportional to the expected returns. And then the third factor, which is the macro factor, which is also something which people need to understand, that if you're coming it at a point when the valuations are higher, your return expectations have to be that much more muted compared to, let's say, what you have received in the last 2-3 years. This is another folly that people do, where the risk management comes in, where everything comes in, which I spoke about. There's a lot of, and that's why I think there's a space for RIAs. Like traditionally, PMS has been more of a distributed product, but the distributors are, in many cases conflicted, because they are only going to give it to the guy who is giving them the maximum share of revenues. And hence now SEBI wants to push more of this RIA model, where these RIAs get paid by the client, but they are focused on to selecting the right funds for their clients, depending on the client's particular risk profile, return profile, AUM, etc. So I think that is something which is very much needed in this market, for the investors to be able to pick the right PMS also.
Marvelously articulated. So let me shift gears and outside of investing, right? What are some of your personal interests, and how do you disconnect from the market?
Yeah, so I mean, I love watching videos which are related to travel plus food sort of a genre.
Mm.
So I follow some of the YouTubers there, and this is personally something which is sort of a activity that I do on a daily basis after I come home. Plus, I have a 6-year-old son, so a lot of time goes in playing with him and making sure that I'm reading out something to him. And basically, I'm a voracious reader, so I do want to inculcate the same habit in my child as well. So some of the time goes into trying to do that. And apart from that, again, reading for myself as well. I think these are the 2, 3 things that I enjoy a lot. Yeah.
I'm glad you said you are a voracious reader, because my final question to all my guests is always, to recommend us 3 books that my listeners can benefit from. It can be investing related or non-investing related, but 3 books that significantly helped shape who you are today.
I mean, the name, I think, so this is where I also have a very strong opinion that, there are Bibles when it comes to investing, for example. And people should not look for newer Bibles, because those Bibles will always remain as the best sellers and the best sort of books for anyone to approach. So, at the risk of maybe repeating it on this forum, and many of your other people would have said the same thing, but for the uninitiated, for people who are interested into investing, exploring, The Intelligent Investor by Ben Graham is the best possible book to start with. And my thinking is that, as you sort of read the book, you should also apply those learnings into the market with some small amount of money. It is very
True.
important. So, Yogi Berra has said a very important thing. In theory and practice is the same, but in
Right.
practice, it is not.
Not.
So it is very important to also apply the things that you are learning by reading each of these books. And then as you are able to graduate into, let's say some people like, special situations a lot. So, there's a book called You Can Be a Stock Market Genius by Joel Greenblatt. So you can read that and then sort of do more special situations in real world also. Start with small money, but it is important. And similarly, if someone wants to um, pursue the detailed financial analysis or growth investing, for example, Philip Fisher has a book, Common Stocks and Uncommon Profit. That is a book which is very relevant from an Indian context,
Mm.
because many of these American books don't lay emphasis on, the business or the promoters, etc. And that book is also very interesting to read for a newbie. And of course, as you graduate, there are tons of books. Like there's a book called Outliers, which is focused into capital allocation, but those are advanced books. I think one should read that once you have finished the initial books. So I think, as I said, I mean, there are the old classics, and one should focus on that. It is not that. And by the way, unfortunately, most of the Indian authors have not done a good job.
Mm.
So I've read almost every book which is there. I think there was one journalist who published this book, Bulls, Bears, and Cartels, something like that. I forgot the name of the journalist, but
Yes, yes.
that is very interesting book to read. But other than that, in general, I have not found great books written by Indian authors. But I think, one should. I mean, reading is very, very important because this is a knowledge industry. There is but also very important is to apply those learnings and develop your own unique approach. Today, I would not say that I'm investing like Warren Buffett. I'm also not investing like Benjamin Graham. I have my own way, which is a mix of all these ways and whatever I've learned from the Indian markets and a specific situation that I have dealt with. So you are some of your experiences, and it is very important to apply. That's how you magnify your learning, by what you accumulate through reading.
Very well articulated. You have Sarvesh Gupta by yourself. And, it's been an absolute pleasure catching up with you, picking your brain and getting to know your philosophy and more about your fund. I look forward to more such, interactions. Maybe we can do sector specifics later. But it's been an absolute pleasure to introduce Sarvesh to our fund manager series. And thank you, Sarvesh, for taking time to speak with us.
Thank you, Radhakrishnan. Thanks a lot to you and your team. Thank you.